Brad, the Humble Trader, again for my second video post. Today is quite an important post. I have a whole bunch of charts that I'm going to show that show what I see as confirmation of a change of trend from which was either bearish or uncertain to now bullish. And I hope by the end of this video you'll agree that being short in this environment is trading against the trend, and not really the best in any time frame. Really is the best thing to do if you're going to make money. I'll show you why. Now, the way I'm going to show the change of trend, I'm going to show using a whole bunch of relative strength charts that I use, which I've been waiting for to confirm this change in trend. I mean, obviously from the February lows, the trend has been up, and that's just short-term trend. Your intermediate trend was down because of the higher lows and higher highs on an intermediate basis. But about 6 weeks ago, price did go above the 30-week exponential moving average, and it did turn up. So from a Stan Weinstein point of view, that was sort of that was a bullish trend change, but it still hadn't broken resistance, which is something that I was waiting for. So I just want to show a whole bunch of charts that I can show these trend changes. Other things I'll be using are the 50 cross of the 100 on the daily chart. This is the exponential moving averages. On the weekly chart, be showing the 20-week over the 40-week cross, and on the monthly chart, I'll just show you the that as well. So let's get started. I just want to update this chart that I showed you last week, and that being the major low in the silver gold ratio. Now it's broken that the little trend line there, which I showed last week, and obviously silver's had a nice run up, powerful run up since then. But the main thing I was showing you that for was not so much for silver, although you know, silver's a pretty good trade at the moment, but mainly for the market. I think it's a fairly good confirmation, as you can see each time excuse me, each time that it's been down in these levels here. It was considerable lows in the market, and that's where we're at now. So this consolidation period that you see in the market is, you know, I think that's ended. Anyway, let's get started. So what we have is the monthly chart of the SPY, which is the SPX S&P 500 ETF. Now, if you use just the 1 and the 20 moving average, every time that the 1 month moving average crosses down below the falling to the 20 month moving average, that's it. You basically got yourself a bear market, and the opposite is true. If it's above the rising 20 month moving average, then you've got a bull market. These don't change that often, obviously. They're yearly sort of trend changes, and at the moment, as you can see, even in this consolidation period, the 20 month moving average did not fall, even though it just briefly popped down below it. So that trend on the monthly basis with the SPY never actually changed, even though your momentum indicators and even the on-balance volume were very weak. But this is, I think that these will start turning back up now. Anyway, let's keep moving. So the other thing that I think has given confirmation of the bullish trend change has been these are the daily chart going back to the 07 top. We have another cross here of the 50 crossing the 100 EMA. Okay, now every time in green here, you can see that that is crossed, even though there's a false breakout here. But every other time, sorry, I should have made the cursor bigger, but for now I've already started, so sorry, I'll do that next week. Each time that the 50 has crossed bullish, you have a considerable run, okay? And we've had that. We've had a fake out here, but we've gone bullish again, okay? So that's one indication. As you can see, the momentum indicators are overbought, but they can remain overbought for a long time, especially at the start of a really strong bullish trend change, which I think we're at now. let's move on. So this is a weekly chart of the S&P 500. As you can see, each time the 50 crosses the 20 weekly exponential moving average crosses the 40 on the downside, then we're in a bear market. On the upside, we're in a bull market. Once again, it doesn't change that often, so very good indications of a trend change. Now, we had a fake out in 2011. We had a fake out up here at the top too, which is why it's been, at this point, it's been hard to tell what sort of trend the market's been in. But for a second time over the last 6 months, it's changed. As you can see here, it's actually crossed again. So that suggests we're in another bull market. Even though possibly on the short term we are overbought, I would not short this market. Let's continue on. Okay, so using Stan Weinstein's method, sorry, where's the, I just have to put, okay, sorry guys, I don't know why, but my moving average is gone. So the pink 30-week moving average, okay. With his method, he'll only be bullish in the market if the price is above the rising 30-week exponential moving average, which is it clearly is now and has been for about 6 weeks, but it has only just broken the resistance here. Very, very bullish, and I certainly wouldn't fight this. This is what I've been waiting for some time, ever since the February bottom, whether it was going to roll over and continue down. Clearly it hasn't. Now, unless things change over the next few weeks to month, this is very strong. Okay, so I just want to show a whole bunch of charts with the 50 crossing the 100 exponential moving average on the daily charts, a whole bunch of indexes in sector ETFs, just to give you an idea of how the market is positioned right now. So the New York Stock Exchange, okay, broken resistance, bullish. S&P 500, bullish trend change, broken resistance. The Dow, trend change, broken resistance, very bullish. The Nasdaq is didn't end up. It actually used the resistance as resistance for the third time. So I think we might have a bit of a pullback here, which could be a really good entry long. But otherwise, you can wait till it breaks resistance. But bullish trend change. Transports, bullish, just crossed resistance. The Russell 2000, just about to cross, but that will cross, I would suggest. And it's just crossed resistance, very bullish. I just want to show you the US dollar. The US dollar has crossed to the downside. It's currently at support. Probably pull back to the moving averages. I would suggest seeing this trend change that the US dollar has a lot lower to go, which would suggest that commodities are going up, which makes sense when you have a look at these. Okay, we got oil, bullish trend change, broken support, resistance. Looks like we've got a higher to go in oil. Junk bonds, okay, which is risk on trade, trend change, bullish. Silver, very strong, as I showed last week, trend change, very strong this week. And we've got healthcare sector, just crossed the other day on Friday, so we got bullish and a break of resistance, very good trade. Energy sector, we've got a trend change, break of resistance, great trade. Health, I don't know why we've got healthcare twice, but financials, the XLF ETF, we've got just about to have a trend change, coming up to resistance. Okay, so now what I want to do, I want to take you over to my relative strength chart. Excuse me. Excuse me, I just had some water. So my relative strength charts. Now, my blogs about a month ago, more than that, about 4 to 6 weeks ago, I was showing you how strong the breadth was in the market. I wasn't bullish at that stage because for a few reasons, but one of the main reasons because of these charts that I'm going to show you. These charts, relative strength charts that I follow. And these are really good confirmation tools to use for a trend change. So I'm not going to explain each of these because it'll take too long. I'll just show you how well they work. The relative strength, all that does is compares one security against another. So it's always the first security is what we're, so if with this one it's the 10-year bond comparing it to the 30-year bond, so if it's going up, all it means is the 10-year bond is stronger relative to the 30-year bond. Pretty simple. So as you can see here, each time this relative strength chart rises, the market tends to rise with it. Okay, so it falls, market falls, rises together, falls, rises, falls. Now here you can see that there's a divergence, which was a warning that something was going on here. This often happens with the relative strength charts too, so it's a good indication too of just being careful. What we've had, as you can see down here, every time the green has crossed, I just use a 3 and a 6 or an 8 moving average just to use for the cross, but you can see the price behind that. But regardless, every time you see it cross, then you can see the bullish run in the S&P 500. Okay, it works very, very well. Okay, we've just crossed, so that's one confirmation. Let's go through them all. Okay, this is the corporate bonds versus the TLT, which is the 20-year ETF. Okay, every time green, every time it crosses and it heads up, same thing. Every time it heads up, the market heads up also. Okay, each time. Okay, so we've just had a cross down here. The price has broken the resistance there. Okay, so it's very bullish. Now I'm just going to go through these quickly. They're all showing the similar sort of thing, but I just want to go through so you get a good visual. Okay, this is the junk bonds versus the Japanese yen, and once again you can see they rise together, fall together. This currently has just sort of made a higher high and a higher low, and it's sort of broken the high there. Okay, so we've got a small good confirmation there. This is the relative strength of oil versus the 30-year bond. Okay, so chart relative strength goes down, market goes down, up, down. They all go pretty much together except for these divergences here. Shows a good divergence at the tops. Right now we've had a cross to the upside, and it's broken the 30-week moving average also, which is at the moment it's very strong. So we've got here, we've got the S&P 500 and the Japanese yen relative strength. As you can see, it's broken resistance, made a higher high and a higher low, and so once again very strong. S&P 500 to the staples ETF. Okay, similar sort of setup. Every time it crosses and goes up, market tends to go up with it. Okay, all it means is the consumer staples is a defensive ETF. So if the S&P is stronger than the defensive, then clearly the market's going to go up as well. Okay, so we've just had a crossover again. Financials to the utility sector. Utility sector is defensive. Okay, so we've just had a crossover. Once again, every time that it crosses, we have a good strong run in the market, and it's just crossed. Okay, we've got the Japanese market versus the 20-year bond. Same sort of thing. Okay, we've had a cross of the 30-week moving average, and every time that happens, we have a good, nice run in the market. Okay, another thing, we've got the CRB commodities index versus the TLT, which is the 20-year bond. Once again, similar sort of setup. Okay, you've got your green dots showing the nice runs it has, and we've just had a double confirmation here on the bottom, and a higher high and a higher low. Okay, we've got the corporate bonds here to the 20-year. Okay, we've had a nice crossover. It hasn't quite broken the resistance, but I think that will this week possibly. We've got the CRB to the what have we got? The 10-year. Okay, it's got the broker resistance here. Both 50 and 100 exponential moving averages have turned up. They haven't crossed yet, but very strong. We've got the S&P 500 to the 20-year bond. Once again, showing each time that rises above the pink moving average, we get a nice, picks all the bottoms, gets a nice run. we've currently crossed. None of these started last week were actually crossed, so it only happened this week on Friday. So that's why it's important that we see these charts today. Now we've got the junk bond to the TLT. Junk bond is the more speculative risk on bonds, high yields. So what we've got here, we've got a cross break of a small resistance channel, and we've got a break of the 30-week moving average. Okay, getting through them, we've got the XLY, the discretionary to the defensives, and once again we've got a nice cross here. Okay, next we've got the corporate bond to the 30-year bond. Once again, it's crossed and it's broken resistance. Very, very strong. Plus we've got all these positive divergences. Very, very good chart to show strength in the market. Same thing here with the it's a similar chart actually. Let's keep going. Okay, what we have here is the yen ETF. Oh, sorry, it's not the ETF, it's the actual Japanese yen. As you can see with the yen, when the yen falls, each time the yen falls, the market rises. Okay, falls, market down here, sorry, rises. Falls, rises. Falls, rises, every time. Okay, at the moment the yen is falling and it's crossed below the 30-week moving average. It's not falling yet, but I'd say it probably will very soon. This is relative. This is the Nikkei, the Japanese market, and the relative strength to the S&P 500. I'll just briefly show this. Whenever we have strength in the Japanese market to the S&P 500, typically the Japanese market is very strong. It's actually stronger than the S&P 500, but each time that it happens, the S&P 500 typically has a pretty clear run up. Like as you can see here, it's down. The Nikkei is sideways to down, and the actual US market is not. It's up and down, up and down, up and down. Whereas right now, it's gaining strength, so we should have a pretty straight move up, I would say. I don't think there's going to be many pullbacks in this run up. Okay, this is just the chart that I show that things I look for to, they all need to be in place to be bullish, and they've all finally gone bullish. What we have a chart up the top here. This is the European financials. It's crossed here, resistance. We have the Japanese market, okay, which has crossed that resistance. We have the high yield bonds have crossed. The market has crossed resistance, and USO, which is the oil ETF, has crossed. So very bullish. Let's go to the SPX, SP 500 to the Japanese yen, just showing very strong. The market is very strong. Yen's going down. Okay, confirmation, as you can see, each time of bullish runs. This is just a relative strength chart of the gold ETF to the TLT. I'm not showing you for the market. I'm showing you just if at the moment risk on is a factor when it shows that gold is strengthening against the TLT, which for the last little while TLT has been strong. So what's this saying? I assume that yields will be possibly going up in the not too distant future, but we'll see. Okay, that's it, guys. I'm hoping from those charts you can see that it doesn't pay to be short in this market. Yes, short term it's overboard, but like I said at the start of strong runs and the start of bull markets, and actually let me just go back and show you. You know, if you have a look, there's a better chart. Okay, have a look here. Each time we've had a cross of the 50 over the 100, which we've just had. Now, at the 2009 bottom, yes, we did have that big, nice pullback there, which would have been a perfect entry. But if you have a look at the 2010 and 2011 crosses here and here, you don't get much chance to get in. So, although I'll be waiting for, I think we're due for a slight pullback, but any pullback to the 50 moving average, I think it's a really, really good entry. But that's it, guys. I think I've showed you everything here. Yeah, it doesn't pay to be short in this market. So, but this isn't trading advice. This is just showing you the way I see things right now. And if you comment, I'll like it, and I'll talk to you guys later. Thanks.